the Bitcoin paradox. The #1 crypto hater on YouTube has returned. About 6 months ago, I made a video breaking down how MicroStrategy had essentially turned itself into a giant leveraged bet on Bitcoin. My argument was simple. Michael Saylor turned MicroStrategy from a dying software company into a leveraged time bomb that only worked if Bitcoin's price kept going up forever. At the time, this was a pretty unpopular take. The general consensus in the comments was that I didn't understand what Michael Saylor was building, that the video was going to age poorly, and that I was apparently a dumbass. But since I made that video, MicroStrategy has lost nearly $100 billion in market cap, and their stock price is down more than 50%. Fast forward a few months, and I uploaded another video targeting the broader crypto industry, focusing on how the entire ecosystem was much more fragile than people realized. Yet, since that second video went live, the global cryptocurrency market has lost well over $1 trillion in market value, with the total market capitalization dropping over 30%. I'm not bringing this up to take a victory lap over the people who bullied me in the comments, even though I probably should be. I'm bringing this up to highlight the fact that both of these videos were built off of the exact same premise, the fundamental reality that underneath the hype, parts of the crypto ecosystem are incredibly fragile, and underneath the marketing, there are deep structural flaws. Which leads us to the obvious follow-up question: what about Bitcoin? Bitcoin isn't just another crypto project. It is the foundation the entire digital asset industry is built on. It is the very bottom block in a tall, unstable game of economic Jenga. That is exactly what we are exposing today. Bitcoin's price is driven by the exact same false narratives, claims that it is digital gold, that it is the undeniable future of money, and that it serves as an unassailable hedge against inflation and centralized corruption. If you've spent any time in the crypto space, you've heard these arguments 1,000 times. But when you actually start testing these narratives, when you stop looking at the story and start looking at the data, you see a completely different pattern. You see a trend where the story constantly changes every single time the technology fails to deliver on its previous promises. The 3 fails of digital cash. To understand Bitcoin's real value, we have to start with a much simpler question. What is Bitcoin actually supposed to do? When Satoshi Nakamoto introduced Bitcoin in the original 2008 white paper, the vision was clear. Bitcoin was explicitly described as a peer-to-peer electronic cash system. In other words, it was built to function as digital money, a decentralized alternative to commercial banks and sovereign governments where people could send payments directly to each other without trusted intermediaries. If Bitcoin had actually accomplished this mission, it would have been revolutionary. But it didn't. It wasn't even close. Economists generally define money using 3 basic criteria, and when you evaluate Bitcoin against these core functions, it doesn't just fall short. It fails every single test. First, money must function as a medium of exchange, meaning people need to widely accept it as a form of payment for goods and services. As a medium of exchange, Bitcoin is slow, expensive, and fundamentally inefficient. The Bitcoin network processes roughly 500,000 transactions per day. If you think that sounds impressive, consider that Visa processes roughly 65,000 transactions every single second. This means Bitcoin's entire daily transaction volume could be cleared by the Visa network in under 8 seconds. It gets worse. A single Bitcoin transaction carries a carbon footprint equivalent to roughly 1.5 million Visa transactions. In terms of energy consumption, one single Bitcoin transaction uses the same amount of electricity as the average American household consumes over 43 days. This basic infrastructural bottleneck explains why Bitcoin hasn't become a widely adopted payment network. It simply isn't built to be a good one. Second, money must function as a store of value, something you can reliably hold today and spend tomorrow without experiencing massive, unpredictable swings in purchasing power. At first glance, the counterargument sounds reasonable. Bitcoin has a fixed supply of 21 million coins, and historically, assets with limited supply, like gold, have been used to preserve wealth. But a true store of value must reliably preserve purchasing power. Bitcoin has historically been one of the most volatile assets in the world, which is exactly why you don't see everyday businesses or households dumping their entire net worth into it. An asset that can swing 20% in a single month cannot be relied upon to pay next month's rent. Furthermore, despite the online narrative celebrating decentralization, token ownership is highly concentrated. Roughly 2% of network addresses control 95% of the total supply. When ownership is this top-heavy, price movements can easily be manipulated by a handful of whales. That is not the foundation you want for a stable store of value. Third, money must function as a unit of account, serving as a standard measure for pricing goods and services so consumers can easily compare value. Bitcoin fails this completely. Even the few businesses that accept Bitcoin as payment do not actually price their inventory in Bitcoin. They price their items in US dollars and then convert that dollar amount into Bitcoin at the exact millisecond of the transaction. Bitcoin isn't acting as an economic measurement. It is just a temporary digital pipe passing through the settlement. The El Salvador experiment. Whenever you lay out these specific structural failures, the standard response from the crypto crowd is always, well, we just haven't given it a fair shot yet. But we actually did. If you want to see what Bitcoin looks like when a society tries to use it as a real currency, we no longer have to speculate. The real-world experiment has already been run. Back in 2021, El Salvador became the first country in the world to adopt Bitcoin as legal tender. The government launched a national digital wallet called Chivo, mandated that businesses must accept the token, and even handed every citizen a $30 Bitcoin bonus as an incentive to kickstart adoption. This was supposed to be Bitcoin's magnum opus moment, the historical turning point where it proved it could run a real national monetary system. The results were an undeniable failure. According to official IMF data, Bitcoin accounted for less than 2% of El Salvador's total inbound remittances. After years of intense government promotion, legal enforcement, and direct financial bribes, 98% of the population still chose to send money internationally through traditional, centralized financial systems. This is a devastating metric because remittances were supposed to be Bitcoin's ultimate, magical use case, the one arena where it would allow working people to send funds across borders instantly without banks, heavy fees, or friction. Yet when given the open choice, nobody used it. Data compiled by the National Bureau of Economic Research reveals that 60% of those users downloaded the app exclusively to cash out the $30 government bribe and never made another transaction on the platform again. They took the free money and bounced. Fast forward to the present day, and local reports show that 66% of El Salvador's population considers the entire Bitcoin initiative a failed project, while 77% believe that no further public tax funds should be spent to support it. The greater fool machine. If Bitcoin doesn't function as a medium of exchange, fails as a stable store of value, and cannot act as a unit of account, then we are left with a glaring question. Where does the value of Bitcoin actually come from? The answer lies at the very bedrock of the asset. Once you strip away the complex technical jargon, remove the aggressive marketing campaigns, and ignore the social media memes, you are left with a very old, very unoriginal financial concept. Economists call it the greater fool theory. This theory states that the price of an object does not need to be justified by its underlying utility or cash flows, as long as there is an even greater fool standing down the line who is willing to buy it from you later for a higher price. When you analyze not just Bitcoin but the broader crypto market through this specific economic lens, the reality becomes unmistakable. Bitcoin does not generate consistent quarterly cash flows like a stock. It does not produce tangible industrial goods like a physical commodity. In reality, it has virtually no widespread, everyday utility. Its market price is entirely dependent on the collective belief that a greater fool will emerge to buy it for more money down the road. That artificial belief is what generates the initial demand. That demand then drives the market price higher, and the rising price attracts a new wave of speculative buyers looking for quick returns. Every single narrative you hear echoed online serves this exact operational purpose. Whether it's the digital gold pitch, the future of global money argument, or the hedge against inflation theory, these narratives are carefully crafted to onboard new buyers. The moment new buyers stop entering the arena, the entire mechanism breaks down. That is the uncomfortable truth of the asset. It is entirely supported by hope, and its valuation relies completely on the next person paying more. It isn't a monetary revolution. It is simply the largest real-time experiment in the greater fool theory the world has ever witnessed. It might not crash today, and it might not collapse tomorrow, but eventually, you always run out of greater fools. Hit subscribe button so you won't miss our next video, and share it to friends who you think they will benefit from this video.